In this video, we'll discuss the recent benchmark rate increase, inflation, unemployment, and the Federal Reserve's long-term goals. The Fed has stated that it is determined to see a change in the housing market before they ease. This information is for real estate professionals, home buyers, and sellers, giving you the most up-to-date information, helping you make better decisions when it comes to buying and selling property. Stay tuned and we're gonna get right into it. Today, the Federal Reserve recently announced a benchmark rate increase of 25 basis points to a target range of 4.5 to 4.75%. This rate increase, combined with the Fed's statements about inflation and unemployment, will greatly impact home buyers and sellers. Let's take a look at what Jerome Powell had to say about the different sectors and when they are likely to ease.
We can now say, I think, for the first time, that the disinflationary process has started. We can see that, and we see it really in goods prices so far. Goods prices is a big sector. This is what we thought would happen since the very beginning, and now here it is actually happening, and for the reasons we thought. It's supply chains, it's shortages, and it's demand revolving back towards services. So this is a good thing. This is a good thing. But that's around a quarter of the PCE price index, core PCE price index. So the second sector is housing services, and that's driven by very different things. And as I mentioned, with housing services, we expect, and other forecasters expect, that measured inflation will continue moving up for several months, but will then come down, assuming that new leases continue to be soft. And we do assume that. So we think that that's sort of in the pipeline. And we actually see disinflation in the goods sector, and we see it in the pipeline for two sectors that amount to a little less than half. So this is good, and we note that when we say inflation is coming down, this is good. We expect to see that disinflation process will be seen, we hope soon, in the core goods ex-housing, the core services ex-housing sector that I talked about. We don't see it yet. It's 7 or 8 different kinds of services. Not all of them are the same.
For buyers, this could mean similar mortgage rates but more expensive homes. For sellers, this could mean that their home might not be as desirable this year as it was a year ago, or even as it was before the rate increase. Remember, home sales have seasonal trends, and they have a peak in sales in the spring and summer months. Real estate is local, and most people should consult a real estate professional in their area, but generally speaking, you should expect a slight shift to a buyer's advantage this season. We are still seeing extremely low inventory across the nation, with under 500,000 homes for sale nationwide. Supply is going to be a common topic in 2023. Back to inflation, this is what Fed Chairman Jay Powell had to say about inflation and what they expect in the next few months.
It's unique. So I think certainty is just not appropriate here. Inflation, it's just harder to forecast inflation. It may come down faster, it may take longer to come down. And our job is to deliver inflation back to target, and we will do that. But I think we're going to be cautious about declaring victory and sending signals that we think that the game is won, because we've got a long way to go. It's the early stages of disinflation, and it's most welcome to be able to say that we are now in disinflation. But that's great. But we just see that it has to spread through the economy, and that it's going to take some time. That's all.
How long do you see then the federal funds rate remaining at this elevated level?
So my forecast and that of my colleagues, as you will see from the SEP, and there are many different forecasts, but generally it's a forecast of slower growth, some softening in labor market conditions, and inflation moving down steadily, but not quickly. And in that case, if the economy performs broadly in line with those expectations, it will not be appropriate to cut rates this year, to loosen policy this year. Of course, other people have forecasts with inflation coming down much faster. That's a different thing. If that happens, if inflation comes down much faster, then we'll be seeing that, and it will be incorporated into our thinking about policy.
The Federal Reserve has stated that inflation has eased somewhat but remains elevated, and this could mean that the cost of living for home buyers and sellers could increase over time as prices for housing and services continue to increase. However, mortgage rates follow inflation, and mortgage rates had peaked in November and have been coming down since. If inflation numbers continue to come down, you can expect mortgage rates to drop as well. Mortgage applications and refinancing had slowed, but a change in interest rates could help buyers and sellers make their move. One of the biggest problems in the real estate market today is inventory, mainly due to high interest rates not encouraging the sellers to want to give up their low rates, and the increase in home buyers' mortgage rate cost. As far as employment, the Federal Reserve has stated that the job gains have been robust and unemployment remains low. And this indicates that more people are employed and have money to purchase goods and services, which could lead to modest growth in spending and production. The Fed also removed references to the COVID-19 pandemic and supply chain backups from its statement, stating that the economy is on the path to recovery. In this video, we covered the benchmark rate increase, inflation, and the Fed statements about unemployment. We hope this information has provided you real estate professionals, home buyers, and sellers with the most up-to-date information to help you make the best decision when it comes to buying and selling property. We are trying to provide the very best information on YouTube. If you want to join the community, make sure you hit the like button and subscribe for more. Thank you so much for watching, and I'll see you guys next time.